When you move to a new country, I think for most people, the goal is pretty straightforward. Economic stability, assimilation.
Right.
But for millions of people arriving every year, and especially for women, that path to financial success is just incredibly complicated. There are all these structural barriers, cultural influences, economic headwinds.
That's so true. And that's really what this deep dive is about. We
Yeah.
want to give you a kind of navigation tool. We're not just looking at the challenges, we're really digging into the data.
What kind of data are we talking about?
Everything from decades of U.S. Census statistics to, global G20 policy reports. The goal is to find those surprising insights that really flip the script on who's succeeding and, more importantly, why.
So our mission here is to unpack that whole immigrant financial journey, understand the real barriers, but also highlight the specific, proven ways to get past them.
And we have to start with the initial economic reality, the wage gap that basically greets people when they arrive.
Yeah, let's set that stage.
Okay, so when we look at the data, both men and women who immigrate, they almost always start out earning less than the native-born population.
Which makes sense. You're adapting to a new labor market.
Exactly, that's expected. But what's really concerning, and this is the key finding, is that for new groups of female immigrants, that penalty, that initial gap, has been getting consistently larger over the decades.
So it's not staying the same, it's getting worse.
It's getting much worse. The research shows a really dramatic shift. So think about the female immigrants who arrived in the late 60s, say the 1965 to 1969 group.
Okay.
They started out making only about 2.6% less than native women. A pretty small gap, manageable.
And what happens when we jump forward, 30 years or so, the cohort from the late 90s?
That's where it gets staggering. That group, arriving between 1995 and 1999, they faced a massive initial penalty of 21.6%.
21%. I mean, just think about what that means in real terms when you're trying to find an apartment, pay for childcare, maybe send money home. It makes those first few years incredibly tough.
It's a huge disadvantage right out of the gate.
So the obvious question is why? Is it just a skills mismatch? Are newer arrivals coming with less education or something?
That's the first thing researchers look at, of course.
Yeah.
And when you control for variables like education and skill level, it does narrow the gap a little.
A little.
Yeah, for that newest cohort, the gap improves from negative 21.6% to negative 15.7%. So skills matter, but they don't explain most of the difference. And they definitely don't explain why the gap keeps widening over time.
Okay, that brings us to one of the most, I guess, counterintuitive findings in the material for me, the geography part.
Ah, yes, the state of settlement.
Right. I would have assumed that if you control for where someone settles, California versus Maine, it would clarify the picture, maybe even shrink the gap because you're comparing people in the same local economy.
You would think so. Everyone thinks so. But it did the complete opposite. When you control for the state, the observed wage gap actually got bigger.
Wait, how does that work? How does controlling for a location make the difference worse?
It's a really important insight into the market. So think of it this way. A lot of new immigrants tend to settle in areas with a lower cost of living.
Okay.
And those places also tend to have lower wages for everybody. So when you just look at the raw national data, that lower wage environment is kind of masking the true size of the gap.
Ah, I see.
So when the analysis compares an immigrant woman to a native woman in that exact same low-wage state, her economic performance is revealed to be, significantly worse than the local average. The raw number was actually underestimating the problem.
That's fascinating. So it's revealing that the economic forces creating this disparity are deeper than just local market conditions.
Precisely. And this is where we really have to pivot and focus specifically on immigrant women, because their choice to enter the labor market is fundamentally different from men's.
And this is where we get into selection bias, right? The idea that we're only seeing part of the story.
Exactly. Unlike immigrant men, where the decision to work is often driven by just, immediate economic need, the primary earner model for immigrant women, it's more complex.
How so?
Their labor supply is heavily influenced by factors from their source country. We're talking about deep cultural norms, gender roles, and just the general rate of female labor force participation back home.
So the very decision to even look for a job is a selective choice. It means the women we actually see in the U.S. workforce are already a pre-selected group.
Yes. And that leads us to this analytical tool, the Heckman selection model, which is honestly where the big aha moment of this whole deep dive is.
Okay, so this model corrects for that bias. For only seeing the wages of women who choose to work.
It tries to, yes. It has to account for the characteristics of the women who decided not to work to get a true picture.
So let's look at the standard results again first. Even after controlling for education, race, English fluency, all of that, the standard model still showed immigrant women making 7.21% less, a persistent disadvantage.
Right. Now, to run the Heckman model, researchers use what are called instrumental variables. These are factors that influence the decision to work, but don't directly affect wages.
And what did they use?
This is what's so interesting. They used variables like the number of children a woman has and the overall fertility rates from her home country.
Why those specifically? How do they act as a proxy for motivation?
Because they capture these unobserved characteristics. The sheer drive, the internal motivation that would compel a woman to overcome huge cultural and practical barriers to get a job. I mean, if you're from a culture with low female labor participation and you choose to work while raising a large family.
You're demonstrating an immense unobserved drive.
Exactly. So when the researchers fully adjust for this deep layer of selection bias, when they account for that unseen motivation, what do you think happens to that 7.21% wage disadvantage?
It must shrink.
It doesn't just shrink, it reverses dramatically.
It reverses.
The findings show that in several models, immigrant women actually end up making more than their native counterparts. In one model, it was 2.88% more. And this holds true for older cohorts, too. Once selection is accounted for, their wages are generally above the native level.
Wow. That is a colossal shift. You go from a significant disadvantage to a measurable advantage just by accounting for who actually made it into the workforce in the first place.
Right.
So what this really means is that the immigrant women who succeed in entering the formal workforce aren't average. They are, by definition, highly selected, high-performing individuals.
Absolutely. The implication is profound. The market is actually rewarding their unseen drive and productivity once they get in the door.
Yeah.
The problem isn't their capability, it's one of access. It's the structural barriers that keep this motivated talent from even engaging.
That completely flips the policy discussion then. We move away from macroeconomics and into very practical solutions. If the talent is there and the motivation is confirmed, we have to focus on dismantling those barriers.
We do. And the most crucial tool for that, as highlighted by organizations like the OECD and the G20, is financial literacy.
And this isn't just about budgeting.
No, not at all. It's a critical tool for social and economic inclusion. It allows marginalized groups to navigate these really complex systems and, build long-term wealth.
And tied into that is the massive global flow of money from remittances, the money that migrants send back home.
The scale of remittances is just staggering. It exceeds all international development aid combined. This money is essential for reducing poverty and creating investment opportunities back home.
I remember there was a big push to make those transfers cheaper.
There was. Back in 2009, the G8 set a goal to reduce the global average cost of sending remittances. At the time, the fee was a steep 10%.
10% is a lot.
A huge cut. The goal is to bring it down to 5%. And that reduction alone means billions of dollars go directly to families instead of, being eaten by fees. That's real economic empowerment.
But even with that global focus, individual migrants still face these huge barriers to financial inclusion on the ground. Let's start with the most basic one, language and culture.
It's the first wall you hit. If all the Bain forms, the official documents, the financial education materials are only in a language you don't speak, the system is immediately closed to you.
And then you have cultural factors.
For sure. A fear of debt, or maybe a stigma around discussing money with strangers, that can push people toward informal, less secure systems instead of banks.
And then there are the bureaucratic hurdles, which can be just as bad, just opening a bank account.
This is a massive issue. Really strict documentation requirements. You need this specific ID, this proof of residency. They often act as a gate, locking people out, especially refugee women. If you can't get a bank account, you can't really participate in the formal economy.
But this is a barrier that policy can fix, and we have proof. Tell us about the success story from Sweden.
Sweden is a fantastic example. They saw that these strict ID requirements were the main choke point for refugees. So they just simplified the banking procedures. They relaxed the initial documentation rules.
And what happened?
The result was almost immediate. A 40% increase in banking access for refugees within just 2 years. Right. It just goes to show, if you simplify the bureaucracy, these highly motivated people will participate.
It's incredible. Okay, and the third barrier you mentioned is relevance, making sure the education actually fits the person.
Yes. Generic advice just doesn't work. If you're teaching a class on how to save 10% of a fixed monthly salary to an audience that works gig jobs with irregular income,
It's useless.
completely. The programs have to be customized. They need to address things like managing unpredictable income or how to send remittances securely and affordably. There was a great study in Indonesia that showed when you targeted financial education at both the migrant worker and the family receiving the money back home.
You empowered both ends of the transaction.
Exactly. And it led to real, observable changes in saving behavior for everyone involved.
Okay, let's zoom in on the specific pathways to stability for an individual. The foundation for everything in the U.S. financial system is credit. How does a new arrival even start building a credit profile?
First, you have to understand what makes up a FICO score. And the number one factor by far is payment history. It's 35% of your score.
So you need to have accounts and pay them on time.
Every single time. And you can start building that credit with either a Social Security number, an SSN, or an individual taxpayer identification number, an ITIN.
And what are the first tools you should reach for?
The classic starting point is a secured credit card. You put down a deposit, maybe a few $100s, and that becomes your credit limit. It guarantees the bank won't lose money, so it minimizes their risk, and it immediately starts building a payment history for you.
What else?
You could also be an authorized user on a family member's card, if they manage it well, or get a small loan with a cosigner.
The most innovative program mentioned in the sources, though, has to be the Mission Asset Fund's lending circles. It feels brilliant because it merges a cultural practice with modern finance.
It's a total game changer. MAF saw that many immigrant communities already have these informal group savings circles, sometimes called tandas.
Right, where everyone puts money in and takes turns getting the pot.
Exactly, it's based on trust. So MAF formalizes these zero-interest group loans, and then, this is the key, they report the participants' consistent monthly payments to the major credit bureaus.
So their trustworthiness, which was already known in their community, now becomes visible to the entire U.S. financial system. It instantly generates a credit history.
It's a pathway built on existing social capital. It's an amazing bridge.
Let's talk about entrepreneurship now. It's such a huge engine for immigrant success. If someone wants to start a business but their personal immigration status is complex, how can they get capital?
Here's the most powerful fact. Regardless of your personal legal status, anyone can start a business in the U.S. and get a business employer identification number, an EIN.
And that's key.
It's crucial. By separating the business as its own entity, you can use that EIN to apply for business credit and loans without ever having to disclose your personal immigration status.
But new businesses, especially immigrant-run ones, often get turned away by big banks. What are the most accessible funding options?
Microloans are almost always the best starting point. They're smaller loans, usually up to $50,000, but the average is more like $13,000. And they're managed by nonprofit community lenders, not big banks.
So they have more flexible rules.
Much more flexible. Their whole mission is community development, so their lending criteria are totally different.
What about the big government programs like SBA loans?
They're mainly for U.S. citizens and permanent residents. However, legal non-permanent residents aren't completely shut out. They might qualify, but the conditions are strict. You usually need to have operated the business for at least a year and have plenty of collateral inside the U.S. It's possible, but it's a high bar.
And beyond that, what other sources are out there?
The alternative funding world is growing really fast. You have crowdfunding on platforms like Kiva, which offers zero-interest loans specifically for financially excluded entrepreneurs. For bigger ventures, there are angel investors and VCs. And you should always be looking for small business grants and fellowships from places like the Roddenberry Fellowship or the Emerson Collective.
So this whole deep dive, it's really a story of contradiction. We've gone from decades of data to securing a microloan. How do we synthesize this for everyone listening?
I think the main takeaway is this paradox. The visible data shows this widening wage gap for new immigrant women. It looks like a growing problem. But the deeper modeling, the analysis that corrects for that selection bias, it confirms that the women who make it into the workforce are overwhelmingly skilled and motivated. They often outperform their native peers.
Which means the entire focus has to shift. The problem isn't the individual's talent or drive. The talent is there. The challenge is the structural environment that holds them back.
Exactly. The solutions are in policy. Things like multilingual financial resources, flexible ID requirements like we saw in Sweden, and educational programs that are actually relevant to their lives.
We have to move from seeing this as a deficit to seeing it for what it is, a reality of high potential.
Yes.
So, if the economic data confirms that successful immigrant women are skilled and motivated enough to overcome huge initial wage penalties and cultural barriers, we're left with a final thought for you to explore.
Well,
What is the true hidden economic cost? Not just to those talented individuals, but to the entire host country's economy of all the structural red tape and the lack of financial inclusion that keeps this incredibly motivated, highly selected group on the sidelines for their crucial first few years.